Hi, good day everyone. Welcome to the latest edition of Fund Manager View. Today we have with us Mr. Kashyap Javeri, Fund Manager of MK Investment Managers. Hi Kashyap, thanks for joining us.
Thank you, Sonali.
So let's start with the elephant in the room. Rising interest rates and shrinking liquidity. What is your view regarding the impact of these two on the real economy going ahead in 2023?
So I think, Sonali, what we need to understand is the causality. High growth usually causes inflation, and inflation then translates into higher interest rates. I'm okay so far as we address the beast in the room, which is the inflation, which is caused by the growth. So far as we can address that question, I think rising interest rate should not necessarily be bad for us, bad for the economy, or bad for real sector either. Who wants low interest rates, but which arises because of lack of growth, right? We are all investing in the market for growth. So far as growth is causing inflation, inflation is causing interest rate rise, but we can control that beast in the room. I think I'm fairly okay. And I think RBI is doing phenomenally well job on addressing inflation at this point of time. I think by the time we move into the first quarter of next financial year, inflation should be pretty much within the bounds that RBI has set for itself. So I think I'm okay with that. I think what we also need to understand is the fact that when we look at the interest rates today, 1 year MCLR of, for example, HDFC Bank at about 8.6% is not materially higher than where probably we left in 2019 December. I think it's just about 30-40 bips higher than that. So in terms of interest rates, they have risen for sure, but I don't think it's alarming at this point of time. And so far as liquidity is concerned, I think the market usually looks at the left balances, and that's what people usually keep looking at. I think that's missing the point completely out here. I think what we need to look at is the number that RBI reports fortnightly basis, which is excess durable liquidity. Today the government has been borrowing money from the market but not spending the full amount in terms of its own schemes. Moment that happens, you will see significant amount of excess liquidity coming back into the market. I think if you look at the excess durable liquidity today as a percentage of the deposits, that number is as about 1.5%. And I think that should address all the liquidity concerns the market has. Besides that, I think RBI itself has a lot of firepower within its belly. So you have CRR, which is today 150 basis points higher than where we were during the COVID. It's still about 50 basis points higher than pre-COVID. RBI has got significant firepower in terms of doing OMOs. So I think liquidity today or interest rates is not something which is concerning me a lot. And like I said, if the growth continues and it causes moderate inflation, I'm pretty much okay with that. So I think the interest rates or liquidity I don't see as a cause of concern for the real economy as we move into 2023. That's not an issue for me.
And there seems to be a certain level of slowdown in the economy that's happened during Q3 FY23 as seen through certain lead indicators that have come out right now. So our PMS strategy, NV and AIF5 are focused and bullish on the manufacturing theme. So how do you see this entire bullish trend that has been happening over the last couple of quarters? Do you see this sustaining and going into the future in 2023 as well?
So I think, Sonali, we have addressed this in quite a long way in our newsletters that we have released for our most of the strategies. So what we are seeing over here, there was a significant slowdown that happened in October 22. That also happened partially for the reason that if you recall, Diwali in last year was in the first week of November. This time we had Diwali starting in the third week of October itself, which means that a significant amount of growth which is related to festive season actually came in September 22, unlike last year where it came in actually October 22, right? So that's point number one, that's more seasonal in nature. Point number two is that if you look at the overall growth construct, it's, if you look at most of this lead indicator, whether you look at railway freight, whether you look at electricity generation, whether you look at issuance of e-way bills, whether you look at the loan growth, all these lead indicators have actually bounced back quite meaningfully in November and more meaningfully in fact in December 22. So I think that was bit seasonal in nature or a bit driven by the festive season. Having said that, two clear indicators or two clear spaces where I see a bit of slowdown happening is one, something which is related to rural. So there is a clear cut or very clear a slowdown which has happened in rural. I think over there what I see is that bounce back will be driven by a couple of things. One, if you look at generally the wages in rural area, they were in real terms negative, far negative until October or September 22. That's seen a significant improvement. So rural wages on real terms are rising. Point number two is that Rabi crop is supposed to be, really good, and the pricing is also supposed to be, quite great. So that ideally should address rural. And if you listen to some of the FMCG goods calls, which happened for this quarter, HUL clearly said that the rural demand is now showing some green shoots. The second part of that slowdown is actually the export part, where you can see the containerized cargo which is transported by even railways has seen meaningful slowdown in October and November. Again, that has bounced back in the month of December, and January month till date has been quite okayish. I think the biggest slowdown over there has been coming from primarily one source, which is related to commodities. So if you look at iron ore exports have come down dramatically. If you look at iron and steel exports, because of the export tax that we had, have come down dramatically. If you look at oil downstream, the export number has come down because of the export tax which was imposed. I think once we see a bit stable impact of this, or rather we see removal of these taxes on the export side, I think that's where the true picture will arise. So I think urban doing phenomenally well. Rural, there are green shoots which are visible at this point of time. On the export side, I think we will have to wait a bit of a time for those export taxes to go away, and then we will see the real picture. But if you look at exports excluding oil downstream and excluding the iron and steel, electronic goods have done phenomenally well. Some of the agri commodities have also not done well because to secure our own supply chain in food, the government has been coming out with a lot of policies to curb the exports there also. So right, so that's also we have seen. So overall, like I said, urban doing really well, rural bounce back because of the green shoots, and exports will take its own bit of time to stabilize. So I'm still quite sanguine about our manufacturing strategies, both NV as well as AIF5, which we have recently launched.
So that's good to hear. But if you had to invest, what would be your top 3 sectors that you would invest in right now in the manufacturing space?
So I think one very distinct, investment avenue that comes to my mind is actually auto ancillary. I think India has been doing phenomenal job there. I was at Auto Expo 2023 just about last week, and I could see, there was so much zeal around with all these companies to launch new products and get, higher share of pie with the OEM. I think what we will pick, in some of our investments will be auto ancillary, particularly the ones which have got, products ready for launch in the export market, because India today sells, probably 3 million vehicles. We have been selling the same amount of vehicle for last about 3-4 years. We are looking at decent growth over there, but the 3 million market is not something which is I'm happy with. So if an auto ancillary has to win the proposition, they have to go global. So we are looking at local in nature, right, which is global plus local. So I think that's going to win handsomely if somebody is doing that. The second sector which comes to my mind is actually the one which is beaten down actually last year second half, which is specialty chemicals. I think the prices have corrected a lot over there. What we are seeing is a lot of commodity chemical companies masquerading as specialty chemical. I think you got to separate them. But once you separate them and you identify some of these, chemical companies which are doing great in specialty, I think that's one where I'm really looking at to make, great returns, because the prices have corrected a lot. The third sector that we are looking at in terms of our investments is actually capital goods, because I think if we are looking at great domestic demand, and if you're going to look at exports also coming back in the in let's say the first half of next financial year, I think Indian companies across the board will have to expand capacities. Again there I think the capex boom that we are going to see, or rather we are going through as of this point of time, in fact today itself, I think it's going to manifest itself much widely as we go forward, and there will be bigger opportunities available there. So I think that's also something that, and within that we are not looking at EPC companies for sure. What we are looking at is product companies where they have product expertise. Probably they are one of the top 3 in this country or globally to make it. And again, global is the opportunity even there. So somebody who is looking at global market, European, US markets to sort of export their goods, I think that would do really well as we go forward. So auto ancillary, I would say chemicals, and within that particularly specialty, and capital goods, and within that particularly I would say capital goods which are in the product side and not the EPC side. So I think that's broadly my theme for next year.
That was actually really insightful. Thank you so much for sharing your views with us, and looking forward to having you the next time as well.
Thank you, Sonali. Thank you so much.